Hello, everyone. Welcome to my Monday night webinar series. Today, we're going to be talking about covered calls and how you can use this strategy as income. Many of you guys already own 100 shares of stock, so why not bring in some extra premium in addition to your portfolio? My name is Dr. Uchenna James. I'm a practicing pharmacist and also a badass stock options trainer. Yes, I practice pharmacy by day and I also trade by day. And I'm going to show you one of the strategies that I use to gain passive income. It's called the covered call strategy. So, welcome and thank you for joining me today on our Monday Live webinar sessions. So, this is all about getting paid to wait. Okay. I'm going to show you how you can put on this particular strategy and day by day collect something called premium that just hits your account. Let's go. Okay. Welcome to my Monday night live session. I will be here with you every Monday night, 7 p.m. Eastern Standard Time. This is the room where it happens. So come join me. So, my mission is to empower women to gain financial independence by trading stock options. Of course, men, you're welcome as well. But my expertise is training women. So come on, come all, and bring your crowns because you truly are royalty. So tonight, we're going to be talking about covered calls, getting paid while you wait day by day on stock that you already own. We talked about the cash secured put last time, which is the wheel. And as a recap, selling a put can help you buy stock at a discount. So this is a strategy that we use after we already own 100 shares of stock. We can sell a call against that position and bring in premium. So let's get going. And next Monday, make sure you stay tuned. We're going to be talking about reading the option chain. Okay, so make sure you stay tuned for that as well. Every Monday, 7 p.m. Eastern Standard Time. So, what are you going to walk away with from tonight? Number one, the landlord frame. How to think about shares as property and bring in premium that helps pay the rent. Okay. Number two, the full mechanics of a cover call. I'm going to show you how to set that up on our platform that we use to trade, think, or swim. Three, strike. What strike are we going to use to sell that call at? We're going to sell it above our cost basis, and that's the setup where every door is a good door. Number four, all three expiration outcomes. So, what are the different scenarios that could happen in the covered call strategy? And none of them should scare you. So, what's the big idea? When you own shares of a company, you actually own part of that company. Your shares are property, and the premium is the rent. Okay. You wouldn't let a tenant live in your property rent free. A covered call is how your stocks can start paying rent. Now you need to have at least 100 shares of the stock before you sell a call to make the covered call strategy work. Okay. The call that you sold is covering the 100 shares of stock. So let's go. Let's take it back in case you guys forgot. What exactly is a call option? Okay. First of all, a call buyer. When you buy a call, you pay a premium today. When you buy a call, it gives you the right to buy a stock at a set price, which is also your strike price, until a set date, which is the expiration date. As a call seller, which is what we're going to be talking about tonight, you collect that premium immediately. Of course, when you sell something, you get money for it, right? That's called the premium. And you take the obligation to sell. I thought that was a bird, but it was a fan. Let's proceed. Okay. So, as a call seller, you collect the premium immediately. You take on that obligation to sell the stock at the strike that you chose. You keep the premium no matter what happens to the stock. Okay. Tonight, we're going to be talking about selling calls and how to collect that premium up front. So, what exactly is a covered call? And let me break down the strategy. When you own a covered call or put that strategy on, you actually own 100 shares of stock. You already own the goods. You sell a call against the 100 shares. You want to sell the call at a strike above where your stock is currently trading at or where you paid for the stock. So you want to sell a call above it. I'm going to show you how all this looks on the option chain. As you know, all options have an expiration date. I like to go 2 weeks to about 45 days out when I sell my calls. Okay. As soon as you sell a call, the premium hits your account immediately. So I already get paid for selling that call immediately when I put the trade on. You get to keep that premium regardless what happens to the stock. And let's say you own 300 shares. You can sell 3 calls if you would like and even get triple the rent. Okay, so let's talk about the real numbers. Uchenna, show me the money. I got you. Okay, so the real math. Let's say you own 100 shares of a $50 stock. What is that? That position is $5,000. Okay, let's say you sell a $55 call, which is about, let's say, a 30 delta. And, if you don't know this terminology, go to my website, download the options workbook where I have all the terminology there for you. Okay. So I usually like to sell my calls 1 week to 1 month out, depending on, what the stock is actually doing. Let's say I got a premium of $1 or $100 because it controls 100 shares. So that's call that I sold above the stock is out of the money. So it gives my stock some wiggle room to move. That $100 that I receive from selling that call hits my account immediately. Okay. So every day I make money from that sold call based upon theta. Yes, the premium hit my account immediately, but I'm still in the position. In order for me to get out the position, I have to either buy it back for a less price, right? If I sell something, in order for me to make money, I got to buy it back at a cheaper price, right? So every day that theta decay is slowly working its way out of that short call. So then at the end, when I get out the position, I keep I can keep, almost all or most of my entire premium if I want to get out of it before expiration. If I want to hold it to expiration and the short call stays out of the money, guess what? I keep the $100, all of it in my account. Okay. So if you look at the math, that's 2% of that position in 1 month. What if I do it again the next month? And then the next month, 12 months in a year, I can make 24% from this strategy alone. And the stock doesn't even have to move. Let's see what that looks like. Okay. So the setup is very, very important for this strategy. You got to pick the right strike. Okay. So, rule number one, you sell above your cost basis. So, if your cost basis for those 100 shares of stock is $50, so that position is $5,000, like we talked about. I want to sell a call above $50. I gave you a pro tip of selling the out of the money 30 delta, which is going to run you about selling a $55 strike call. For an example, if you bought at if you bought the stock at $48 and you sell the $55 call, even if it gets called away from you, that's a $700 win plus the premium that you received from selling that $55 call. Now, why will the call get called away from you? The stock. The stock will get called away from you if the stock goes above that 55 strike call. Okay. Rule number two, sell a strike that you'd be happy to sell your stocks at. So if I bought some stock for $50 a share and I bought 100 shares and I say, you know what, this is just a trade for me. I want to make $500. So I already collected that $100 premium. If the stock goes up to $55 and above, I'm capping how much I can make on the stock by selling that strike at 55, but I'm okay with it. That's how much money I planned on making in this trade. So if the stock goes above my 55 strike call, I can't be upset because I made money anyway. Okay. And rule number three, make sure you sell the calls out of the money 30 delta 1 week to 1 month out. Short dated calls make theta hard to work with, so you really don't get like your full premium until toward the end of the expiration. And the pricier the stock, the lower the delta that you can sell. Make sure you sell above your cost basis. So, like I said, if the stock's cost basis was $50 a share, make sure you sell your call above that cost basis. Okay. You get to keep that premium. Okay. The most common ending for this particular strategy is it that the stock stays below $55 a share. That's kind of what we wanted, right? The call expires worthless if you hold it to expiration and you keep the premium and the shares. Okay. So let's say you received a $100 premium for selling that $55 call. You get to keep that $100 by expiration. Okay. That's 2% in a month. And if you do it every single month, 24% in a year. The 100 shares are still yours. Okay. So what's an ideal month? The stock that you bought at $50 a share goes up to $54 a share. plus you got the $100 premium from selling the call. So you made $400 on the stock because you bought it at $50. It went up to $54. That's $400, right? And you collected an extra $100 from selling the 55 strike call. That's $500 from this particular strategy in 1 month. And you really didn't do anything. You clicked the button, you made sure you followed your rules, and you let day by day the position work for you. I love those odds. Next month, wash, rinse, repeat. Move your strike up on your next month's short call to 60. Rinse and repeat. My favorite type of trade. Hmm. So, what's the worst case scenario? And this is scenario number 2. The stock tanks to zero. Now, if you bought a stock, 100 shares at $50 a share, are you going to sit there and do nothing while the stock goes to zero, which is a $5,000 loss? Of course not. You need to exit that trade. So, yes, you sold the call at $55. You collected the $100 premium, but that doesn't protect that $5,000 investment of the stock, right? Of course, you get to keep the $100 from the short call, but the risk is still with the stock. That's $5,000 worth of risk, right? In theory, it can go to zero and you could lose $5,000. That's why we need to make sure our exit rules are sound. We would exit the stock if we feel that we don't like, if we don't believe in it anymore, or the trend changes, let's say it breaks like a major level of support, just close out the trade. Just exit the trade, the whole entire trade. Your short call is making money. It might not, if you have to buy back that short call, which you would have to do if you exit the stock early, you might not have been able to collect all $100 of premium. Maybe you made 60%, which is $60. But you want to protect your portfolio from that bigger $5,000 loss. Okay? These are rules, not hope. The call is the short call is the income. The stock still needs to be managed if it begins to tank. You got to remember that, okay? And scenario number 3. And in this bullish market, this has been happening quite a bit. The stocks rip higher above 55, which is the strike that you sold your call at. So what happens on expiration? Your stocks get called away from you. So you made $100 from selling that call at 55. You bought the stock at 50. It went up to 55 and you made $500 from that, right? Because you had 100 shares. So you made a $100 gain from the short call. Then you made a $500 gain from the stock going from 50 to 55. Yes, selling the call at 55 capture upside, but that's the trade that you knew you were going into. We have to be okay with it because we're still making money. Don't be upset if your shares get called away because guess what? You're making money. So, in every single scenario that I just spelled out for you, the premium is yours in every scenario. In every situation, all 3 of those situations, you got to keep that $100 premium from selling the call. That's not gambling. Queens don't gamble. We strategize. Let's go. So when will we not put this strategy on? Okay. So, right before earnings, you have a lot of movement in the stock. It could go up, it could go down more than normal, right? The volatility is high, meaning the amplitude of the stock can go up really high or go down really low. It's usually not the best time to sell a call in those situations. Yes, you're going to get more premium for selling the call, but you don't want to be in a situation where it plummets, the stock plummets, and then, you're having problems getting out. Sure, you can sell a call during earnings if you want to, because the premium, like I said, but let's say you think that the stock is going to go up. Why? Like a lot. You really don't want to cap those gains by selling a call at that time. Okay. If you're going to be really upset that your stock gets called away from you, like let's say it jumps above that 55 to like 60, if you're going to be really upset about that, just don't sell a call against your stock. You want to put these calls, this type of strategy on slow bullish grinding stocks, not on these super duper high flyers, because you might get your stock called away from you. So do it on like these blue chip companies, grinders, your Googles, your Microsoft, your Boeings, your Chase. That's the best type of stock to put this covered call strategy on. And if the premium is very small, like if you cannot get like 2%, it's probably not worth it. Like if I have a $50 stock and I have 100 shares, I put $5,000 in out in my portfolio to buy this stock, and I'm selling a call at 30 Delta and I get like $8 for it. It's just not really worth my time, because that's not going to help really my portfolio grow at the end of the year. If I could do it month after month and I make like what, 8 times 12, what is that, like $96? I don't know. It's not really worth it for me. So I usually don't put this strategy on when the premium is pennies. Okay. Always true. Never sell a call below the price you paid for the stock. If you paid $50 a share for the stock and you have 100 shares, don't sell a call at $49 at the $49 strike. When you see the option chain, you're gonna be like, oh my God, that's so much premium. But guess what you're doing? You're locking in a loss. Like depending on how much you got for that short call, you don't want to lock in a loss on your stock. Okay. I like to exit my short call when I've captured 80% of the premium. I can let it expire worthless. Like I can hold that short call to expiration as long as it stays out of the money. I'm going to get 100% of my premium. But what I've noticed, that some of these stocks, I can get 80% out like within like the first 10 days. If that's the case, I'm going to close out that short call and just sell another one with a further expiration date. Pro tip. Okay. Of course, you need to exit the stock when the trend changes. If you don't believe that the stock is going to be bullish anymore, don't put that $5,000 at risk. Just exit it and pick another stock. Okay. Never sell more calls than the shares that you own. Covered means covered. If you have 100 shares of stock, don't sell two contracts of a call, because only one of those contracts are going to cover the 100 shares. The other call that you sold is naked at that point. You don't have anything covered. And I never sell naked calls because the risk is just too great. I want to be a disciplined trader so I can live to trade another day. Discipline is the brand, okay? The rules are why this works month after month. Excuse me. Okay, so let's do one live. I'm going to show you what this strategy looks like on our trading platform, Think or Swim. Okay, so make sure. Okay, so let's look around for some stocks that we would want to own 100 shares of. I would love to do this on something like Nvidia. You know what? This is my real account. So what I'm going to do is I'm going to log off and log in to my paper trading account. And I'm going to show you guys how to do that. So whenever you want to switch from your real account to your paper trading account, you need to toggle over to paper money. So it was on live trading, go to paper money, same credentials, but as you see, it's like brown. Before it was like green. So now what I'm doing is I'm logging into my paper trading account so we can set up the covered call. And I think I already have some of these set up actually. Let's look at our monitor page. So right now I have 100 shares of AMD. I have 100 shares of Microsoft. I have 100 shares of NVIDIA. And I have two long calls on Tesla. So let's do a covered call on AMD. Let's look at the chart first. Yeah, so this is a good one. Like if you see AMD, this 550 level, it doesn't seem to be able to get above. It did on this day here, but then it immediately sold off. So this is one that I would like to do a covered call on. Let's see what my cost basis was. You always want to check to see what your cost basis is of those 100 shares, right? So my cost basis was 179.20. See that? So like I'm way, way, way above what I paid for it. Like I bought this at 179.20. So this is a perfect one to do a covered call on. So how do I set that up? I go to my trade tab, AMD, open up my options chain. Like I said, I like to pick like 14 days to 30 days out. So let's just do the July 27th and see if we can get some premium. Out of the money calls. All the out of the money calls are the strikes that are greater than where the stock is currently trading at. The stock is currently trading at 534.39. And the market's closed right now. Remember, the market is open 9:30 to 4 p.m. Eastern Standard Time. So I'm going to sell a call above 534.39. I like to do the 30 delta. So what around 30 delta? What thing's trading on this one? That's kind of weird. 585. Oh, the market's closed right now. But let's do something like, wow, these premiums are good. So where do we think AMD is going to stay below? I don't think AMD is going above 560 in the next 14 days. So I'm going to do the 560, which is around a 41 delta call. Now, you buy at the ask, sell at the bid. So the 560 will give me $2,075 because it's a $534 a share stock. So the higher the price of the stock, the more premium you're going to get from selling the call. Okay, this is not a $50 stock. This is a 500 something dollar stock. So this is going to hold up 50. So this stock right now is worth, the 100 shares is worth $53,000. Okay, I'm going to sell the 560 strike call. So I click on it. I look at my order ticket. Sell one call expiring July 27th at 560, and they're going to pay me $20.75 to do that. The market's closed right now. So what I'm going to do is I'm going to put GTC. So whatever happens tomorrow, I want my order to get filled. What do? I can toggle and play with it and negotiate if I want to, but the market's closed. I'm okay with that. I bought it for what I buy AMD for like $180 and it's trading at 534. I made a shit ton of money on the stock already. I might as well just bring in some premium while I hold on to the stock anyway. So what do? Confirm and send. So I make sure that the order ticket looks right, make sure that it's in the right account, and hit send. So then I go to my monitor tab and I look to see the working order. On July 13th, I want to put an order to sell a call of AMD expiring July 27th at the 560 strike, and it's going to pay me $21.70. Same thing as $2,000, 170 cents, because the call controls 100 shares. Okay. I like that premium. I like those odds. So I'm hoping to get filled when the market opens tomorrow. So that's one call that we sold on our 100 shares. We also have 100 shares of Microsoft. Where do we buy it at? We bought Microsoft at 409.32. Where's Microsoft trading at today? At the mark price, which is 389. So our number one rule is we cannot sell a call below what our cost basis was. So that being said, I have to sell a call above 410, right? Because I bought it for 409.32. So let's look at the option chain and see if we can get paid. I also want to look at the chart to see where support and resistance is too. So Microsoft sold off and then it's trying to rebound. It's kind of like staying stagnant. But what do we have here? Earnings on July 29th. So we want to make sure that the call that we sell is going to be way before earnings. Okay. So if we're going to do the 30 delta, I want to get above this resistance here. I'm thinking 410. I'm comfortable with that. Okay. Well, I bought it for 409. So if we go 14 days out, 410 is about a 26 delta. Yes, I like to do 30 delta, but I also want to do it above. I also want to sell my calls above resistance, right? Because I want to be able to do this strategy over and over and over again every single month. So that's why I picked that 410 strike. So I click on the bid, make sure my order ticket is accurate, sell one call of Microsoft expiring July 27th, the 410 strike, and it's going to pay me $385 it's going to put that in my account when the market opens because I'm going to put GTC and then I hit confirm and send. Make sure your order ticket says it right there. So now we just constructed the covered call strategy on AMD and Microsoft. We could do one on NVIDIA also. Look at our cost basis for NVIDIA. We bought it at 105.28. It's currently trading at 203. We've made $9,777. After hours is still trading, that's why it's still moving. Just as long as we sell our call above our cost basis, we're good. So let's look at the chart and see where we want to get in at. So I see resistance around this 214 level. So that's where I want to sell my call. I'm going to do 14 days out at around 215. Let's see what we can get paid for. So 14 days out is July 27th. If I sell the 215 strike call, that's a $2 gain, which is $200. I'm going to put it to GTC so it can get filled first thing tomorrow when the market opens. So, do you see the construction of this covered call? I'm selling in my working orders in NVIDIA. I'm selling a call, the 215 strike, and receiving $200. Okay. I'm selling the call on Microsoft at 410, and I'm going to receive $385. Those are the premiums. I'm selling a call on AMD expiring July 27th, the 560 strike, and I'm going to receive $2,170. Regardless what happens with the stock, once I sell that call, I receive that premium. Okay. The only time that you can lose money on selling the call is if you want to buy back that call that you sold. Let's say you're like, oh my God, NVIDIA went up past my 215 strike. I changed my mind. I don't want to get rid of my stock. If you try and buy back this short call, like the call that you sold, if you try and buy it back because NVIDIA went up to like 218, it's going to cost you. You're going to lose money on that trade. Yes, you're making money on the stock. However, the rule is if the stock goes above the short call, just let it get called away. And then you can start selling puts. Okay. So make sure you understand the construction. You need 100 shares of stock. Then you sell the call out of the money or above where the stock is trading or above your cost basis. And then you just let time eat away and make money on your premium. Okay? It's a very good strategy to know how to do and little effort to do it. Follow your rules and you'll be successful. Let's go back to the slides. Okay. So we just put 3 covered calls on live on NVIDIA, AMD, and Microsoft. Once a month. Actually, we did 14 days. Imagine if we could do that twice a month. But let's just say once a month, 12 times a year. If I own 100 shares of a stock that I bought at $50, that's 2%. If I sell that call at 55 and make $100, a year is 24%. Not even considering any of the gains from the stock. The ideal month, I keep that $100 premium from that short call. The stock goes from $50 a share to $54 a share, and I keep that $400 from the stock. Wash, rinse, repeat. That's the Queen's move. Next month, sell the 60 strike call and run the whole thing all over again. Let's get paid. One strategy gets you started, a system sets you free. So, if you want to go more with me in depth on these different strategies, I'm opening my 4-week stock options mastery training course for you. One-time cost of $497, and you get lifetime access. It's basically a 4-week training that you do on your own pace, 5 modules, 30 videos, 22 workbooks. It's all about foundation. Week 1, we talk about risk management, brokerage setup on the Thinkorswim platform. You can trade on any platform that you want to, but the way I teach it, I teach on Thinkorswim. Week 2 is the strategies, calls, puts, the watch list, but 10 levels deeper than what we talked about today. The wheel, the 3, we'll talk about the wheel, stacking covered call, cash secured put, and also income strategies like credit spreads. And week 4, we go over your trading plan, making sure your rules are sound. You're going to put your first trades on, journal, and just be the confident, disciplined trader that you're striving to be. Okay? Less than 1 month of this strategy collects for the skills that it collects forever. The first 10 women who enroll with me tonight, you're going to get a one-on-one strategy call with me, just talking about your account. Whatever you want to talk about, we could set it up, your brokerage account, if you don't already have it set up, the plan, different strategies if you're already pretty advanced or intermediate, for free, just by enrolling tonight. I normally charge $497 for this. If you enroll in my course, I'll give it to you at no charge. And you also get 3 more live weekly sessions at the same time, 7 p.m. Eastern Standard Time. And you get my full resource vault. I have my trade entry checklist, options 101 cheat sheet, trading plan template, and 15 other documents just for signing up tonight. I only got 10 spots left. When they're gone, they're gone. Okay? I only got so many hours, and I have to make sure that I'm not, doing too much of my time. So enroll now and sign up for your one-on-one free strategy call with me. Any questions? So just to let you know, I'm here every Monday, 7 p.m. Eastern Standard Time. Next week, we're going to talk about reading the options chain like a pro. Bring a friend. Bring 2 friends. Somebody needs this. Bull, bear, we don't care. Options traders make money when the market goes up and when the market goes down. Let's get paid.